All right, welcome everyone, all the guests here. We have another crypto webinar today. We know this is a bear market for crypto right now, but I just want to point out we have tons of crypto investors come at all-time highs, and they're always really excited. And we have investors that are really strategic, always trying to think ahead. They always come to us in the bear market. So this is kind of, it might be down, things might be down, but it's actually the perfect time to be talking about cryptocurrency. So we're excited. I'm going to do just like a minute or two of IRA education today and something going on at Rocket Dollar. Then we're going to have our guests here at Securitize Capital talk about an opportunity that they have. Really excited. So first, let me just talk about, what is a direct custody IRA versus checkbook control, because we have some older customers that have been with us for many years, and then we have some new customers as well that are buying our new direct custody IRA, which we just launched that this spring. All right, so a direct custody IRA, you can do a traditional Roth IRA that is really similar to what people have at TD Ameritrade and Schwab. The only catch is you can only invest in assets that are approved on the platform. So with Securitize, we worked ahead of time to get their opportunity approved on our custodian platform. So all of our customers using that IRA can invest in it. So they'll skip the deal review processes that has kind of already been done. But a key difference of this from the IRA LLC is that you need to check with Rocket Dollar and our custody partner that they can approve that asset. So for private placements, crypto funds, real estate managed funds, things like that, very easy to do a direct custody IRA. As you could say, you can put your mom or your grandmother into it. They'll have a great time. They'll be able to understand it. We'll be able to get them into that investment opportunity. Maybe someone's first crypto investment that they're doing, they can do that for a direct custody IRA. A lot of our customers, last few years, Rocket Dollar kind of got on the map for this product is because we try to offer it at a much more affordable price. We offer both our IRAs at $360 and $15 a month. And Securitize has an exciting offer that we're going to talk about later on price later in this webinar. But the IRA LLC has a Colorado LLC that Rocket Dollar creates for you and a bank account at our bank partner. And the main difference here is this IRA is a little more complex to set up. We are doing that for you, but it takes, an extra week or two. You got to be involved in the process, communicating with our support team. And you also have to be in charge of sending the money yourself. That's the biggest difference is with the IRA LLC, it's a little bit more for the independent investor that is used to being hands-on. So as we've launched the direct custody IRA, just giving that primer to everyone, we're having some people from kind of both audiences starting to jump into our webinars now. So I'm really excited to introduce Securitize here. Ryan, you take it away first.
Excellent. Thank you, Brendan. I am Ryan.Crvrkel, and I'm going to go ahead and share my screen here in just a moment. But I handle sales and distribution for Securitize Capital and our suite of digital asset funds. Today, we've got a pretty full docket that we want to talk through. So, to give you kind of a agenda for the day, we're going to do some education on stablecoins, do some taxonomy and understanding of the different types. Then we'll bring it into focus on how exactly we work with stablecoins at Securitize Capital in our strategies. And we'll talk through a couple different crypto strategies, both for the current market volatility and for those of you that are thinking ahead and taking advantage of kind of the recent drawdowns in prices to get in with some very efficient vehicles over the long term. Just a blurb on myself. I've spent my entire career in the asset management industry, starting off in front-end loaded mutual funds, then on to index funds. In the last decade, I've spent working with an ETFs. And I'd say one trend that's very well known out there is this continuous march towards further transparency and efficiency in investment solutions that are available to investors. And much the same what we're doing at Securitize Capital broadly with our suite of products, but specifically to crypto. So really trying to take that first generation of products that hit the market and improve upon them for better efficiency, better beta exposure across our suite. So So with that, let me introduce my co-presenter and our CIO here at Securitize Capital, Adil Abdulali.
Hi, great to be with you all today. My background was trading and investing in several sell-side firms on Wall Street for a decade in the 90s. I started investing in private funds and hedge funds in the 2000s. Did that for about 20 years. Seeded a lot of hedge funds and new investment strategies, and got involved in crypto in 2015. We put some money into the digital currency initiative out of MIT when Joey Ito was running it. We were first dollar investors in a bunch of different hedge funds in the crypto space. And right now we're developing and making different strategies on the Securitize Capital platform. And today, really, we're going to concentrate on one of the safest and most interesting ones at the moment, which kind of takes advantage of the difference in demand for US dollars in the regular banking system versus the crypto banking system. So I'm going to talk about stablecoins. Thank you, Ryan. So really, a stablecoin is just a cryptocurrency or a token that can move on the crypto rails, but its value is supposed to stay constant relative to another asset. So the most basic example, and the one that's used most often, is US dollar stablecoins. So that's a digital version of a dollar that can be sent back and forth along the crypto rails. And the idea is that it should stay worth $1. So anytime you buy and sell it, it should be $1, and you can transfer it between any two people, and it'll stay $1. Now, how do you achieve this? I'm going to go into that in the next slide, but I'm going to tell you why. Hold on, not quite there yet. Is that why is this necessary? Like, what does it help you do? And the real problem it solves is that it's actually difficult to send dollars between two people. I mean, if you want to send regular dollars through the banking system, first of all, both parties sending and receiving have to have a bank account, and opening a bank account is no joke. Then, when you send it, it can't be the weekend because the banks, they've gone home. They're like 9 to 5ers, so they're not around like us, trading all hours of the day and night. The flip side, so instead of the bank account for a stablecoin, all you need is an internet connection and a little bit of knowledge. And where do you get the little bit of knowledge? You can even get it on YouTube. So you have an internet connection, YouTube, you make a wallet, you can get a stablecoin, you can send it to anyone in the world. It is way different than the banking system, and you could do it 24/7. So now let me talk about a few different kinds of stablecoins, because stablecoins have actually been in the news. Now you can go ahead, in the news quite a lot. And I'm sure that anyone who's been looking at the crypto news has heard about Terra Luna and the Terra stablecoin that died and this, that, and the other. And let me just tell you that there are different types of stablecoins. One of the types of stablecoins is the algorithmic stablecoins, which is what all this bad news is about, which is the Terra Luna ecosystem. And what that is, that the Terra, the stablecoin, was supposed to be something that you could always exchange for Luna, another token, and its value was pegged at $1 because you could always sell the Luna in the market. The problem is the Luna in the market, when you sold it, it could change in price. And this led to a classic bank run, and the Terra stablecoin kind of disappeared from the ecosystem. There are other kinds of stablecoins that are backed by hard collateral, some type of asset. And the USDC stablecoin is one of those that's backed by US dollars. I'll also touch on another one that's backed by assets called USD Tether. If a coin or stablecoin is backed by assets, then why would it ever change in value? It will change in value depending on how much trust you had in the assets backing it. So for USDC, it actually is backed by US dollars in US regulated bank accounts or US treasuries that have less than 3 months maturity. And that's all there is. And you can check on the website and you can get the CUSIPs of the treasuries they own. The other stablecoin that's quite widely used is Tether. Tether also is backed by collateral, but it is hard to find out what is in that collateral. So they don't have an annual audit. They don't have any kind of attestations. So it's still used. It still has something backing it, and it's still reasonable, but it's less reasonable than USDC, where you can actually be assured that you take your token, you give it to the bank, they give you back $1 because the dollar is just sitting there. So they're very different types of stablecoins, and we're going to concentrate on the USDC that's backed by US dollars and US bank accounts, because that's what we use in our USDC yield fund. And so what is USDC? As I said, it's pegged to the dollar. It is backed by a dollar in a bank. There are annual audits that are completely certified according to GAAP. There are monthly attestations. You can go check whatever is backing them any time, and you can actually find the actual CUSIPs of the treasuries backing them. So the assurance that anybody has that unless the whole world falls apart, your stablecoin USDC can be exchanged for a dollar, and there are reputable people that are going to give it back to you. So that's what USDC is. So what, go ahead, one more, you can advance the slide. So what we do with USDC is we lend it out and put it into a way for you guys to get the lending yield from our fund. But the crux of the matter is, why is a US dollar that's a digital dollar worth more in the crypto market than it's worth in the banking system? And that is where the supply demand for this digital dollar is way different in crypto land than it is for dollars in US banking SWIFT account. And there are a couple of reasons for this. And one of the main reasons is that people who bought Bitcoin and Ethereum early, got into the crypto space and made a lot of money, they own these assets that have appreciated a lot. I mean, you could have had like, millions of dollars in Bitcoin or whatever. And if you sell that, because it's treated as a commodity, you have to pay capital gains on that in order to get dollars out and do something with it, like buy a house, a car, whatever else you might want to do. Instead, if you were to use the Bitcoin as collateral, borrow dollars against it, and then use the dollars to buy that, then it's just a loan, and you don't have to sell the cryptocurrencies in order to make use of the proceeds. So the demand for for that type of dollars is much easier done in the crypto land with USDC than getting fiat. So that's one reason. The other really big reason is that traders in this market, they're buying very volatile assets like Bitcoin, Ethereum, all the other coins. And when you buy and sell them during the day, it's instant settlement. So you can buy a Bitcoin, if it goes up a little bit, sell it. But then what do you keep your money in while you wait for it to go up? It has to be dollars, something that doesn't move relative to your net worth. Well, if you were to do it in the banking system, you have to wait 3 days for the settlement. You have to wait for the dollars to go and come back. So you just cannot trade versus real dollars in real banks. But if you could trade against the representation as the digital USDC coin, it settles instantly. So you can buy and sell, send dollars back and forth a dozen times a day, and it's fine. And the fees are very, very low for this type of transaction. So that demand for these digital dollars, there's as much demand as there's returns to be had by trading cryptocurrencies. And a lot of cryptocurrency strategies make returns of 20, 30, 40% a year. And if you're making that type of return, you can afford to pay much more for your loans in dollars and getting dollars than you can in the banking system. So you can easily pay 5, 6, 7, 8, 9%, borrow USDC, trade, make 20, 30% and pay it back. So there's a lot of arbitrage strategies, funds, investment houses that do this. They borrow, they pay the higher interest rates because JP Morgan is not going to lend them the money, but people like us will lend them the money through USDC. People like hedge funds will lend them the money through USDC, and then they can get the liquidity in order to get their returns. The final thing is just payments. Why in crypto land is USDC valuable rather than Bitcoin? Because Bitcoin can be used for payments as well. But if you pay somebody in Bitcoin, in the morning, it might be like worth $2. In the evening, it might be worth $5. And, it's just very hard to pay for things like coffee and shoes and cars and things with Bitcoin. So if you had a cryptocurrency that you could use the same technology to send it back and forth anywhere in the world instantly, but it would state the value of $1, that's very useful for everyday activity. And so that is another demand for USDC, the kind of digital form of dollars that makes it that makes the crypto world pay a lot higher interest rates for USDC than you can by just putting in dollars in a bank. Now, what we've done at Securitize Capital is make a fund so that we can access all these avenues of demand that pay high interest rates on USDC. and we take your dollars, convert to USDC, and access these high rates of return and pay it back to you. And I'm going to turn it over to Ryan to outline the investment vehicle through which we allow you to access this USDC yield.
Perfect. Thank you, Adil. And now that we understand, what USDC is and this imbalance that exists, how can investors harness this and put it into their portfolio and take advantage? And that's really what our USDC Yield Fund is doing. It's hassle-free access to this lending of USDC coin and the above traditional market rate that comes along with that in a liquid fund structure. So this is an accredited investor opportunity. Important to point that part out. The range in yield that we've experienced since inception is between 4 to 8%, which is much above kind of traditional market yields we're seeing out there in fixed income. And with that higher yield, it's, that output can help you with a lot of other things like fighting inflation. We're going through 40-year highs in the inflationary environment. So the output of this type of strategy in a fund structure has a lot of compelling attributes. Talk about that a bit further as we look at kind of the traditional fixed income environment out there. We've seen some movement in yields, but we're still looking at a 10-year yield at 2.96 and actually a 2-year at 3.16. So actually we've gone through an inversion of the yield curve recently, which is typically a signpost on the way to recession. So, it's been a lot of volatility in the broader markets. What you're looking at here in the graph is the Bloomberg US aggregate bond index, which is kind of just the common denominator for fixed income. And while this has been yielding right about 3.25% as of most recent check, you've also gone through a very steep drawdown on a year-to-date basis of approximately 10% if you're in this kind of traditional fixed income holding. So something like the Securitize USDC Yield Fund has not experienced any of this NAV decay and has been consistent with producing an above market yield. So it can help fill that gap in a portfolio where you've kind of sought traditional fixed income exposure in the past that hasn't been kind of fulfilling its traditional role most recently. So how do we get to that output? What is the investment strategy that we incorporate to get there? It's quite simple. So, we start off with a fund that's fully allocated to USDC, and then we're going to either originate or invest in USDC denominated loans that are directed to high quality credit institutions. The fund is going to strategically allocate assets between different lending pools based on kind of the prevailing risk return attributes in the marketplace. So at the end of the day, we're looking to preserve capital here and generate a yield, but we would certainly sacrifice yield to maintain capital preservation. So we really see this as a vehicle for folks that might be in between risk investment strategies, looking for kind of a short-term place for their assets to earn above market yield as they wait the next opportunity, or just a kind of a flexible strategy to fill that traditional hole that fixed income's left in a portfolio. A little bit more in depth here as we look at how that allocation process actually works. So again, fully allocated to USDC. The fund engages with different digital asset lending protocols. One of the counterparties that we work with is Anchorage Digital. They're also a custodial bank. And they are going to automate that matchmaking process between borrowers and lenders in their pools. Now, that still doesn't alleviate our team's oversight and the research and work we do on understanding the credit risk in all these pools and strategically allocating between them. Once those loans have been made, we're going to be getting interest back into the portfolio on a weekly basis. And as that interest comes in, it's reflected in the NAV and then redeployed for other loans. So you kind of get this continuously compounding vehicle. Redemption here is on a monthly basis, available with 7 days notice. So again, this is a vehicle that has liquidity built into it. And another means to liquidity on our actual alternatives trading system here at Securitize. After a 1-year vesting period, you could go into another one of our strategies that is more risk focused, if that's what you so desire. So there's several different pathways to liquidity with our portfolio.
Okay. And
this is just
question here come in here. Brian asks, can you expand on your yield fund risk management strategies? How do you prevent losses similar to what happened to Voyager and Celsius? So this is obviously a huge topic in the news right now, especially in the crypto world, and some of their loan process and loan choices. We saw kind of only like a few companies that they were lending to, all of them.
So let me take that, because we actually have had outstanding loans directly and through our fund products through this entire period. And so did some of our lending partners. The one that we use principally is Anchorage. And let me explain to you the type of loans that are typical that we do, and that'll kind of point out why it's different from any kind of uncollateralized lending. So the first, most important, it is collateralized lending. So if we get $100 worth of US dollars in, we change it to USDC. If they're going to lend out $100 to somebody and get an interest rate on it, we're going to take in cryptocurrencies, only Bitcoin and Ethereum, $140 worth of Bitcoin and Ethereum. So we generally started with a 40% over collateralization amount. It is margin callable when it goes from 140 to 130. What does that mean? That if our coverage goes from 140 to 130, and this can happen 24/7, anytime the market is open, right? If it goes to 130, they have to post more collateral, or we sell the 130 worth of Bitcoin, take $100 and give the $30 back to them. And that happens, it's just regular routine. Some people actually decide, well, I got this Bitcoin, it's going down, close me out, and we close them out. It's not in our world, it's not even a default anymore. It's just like par for the course. And so Anchorage, Securitize Capital, we had a lot of loans out, a lot of them got liquidated, but everyone was happy. There's no concept of lending to somebody without collateral. That's crazy. So that's basically how we risk manage this thing, is that, with that, on top of making sure that the counterparty is reasonable from the standpoint of an operational performance standpoint, because they have to be around to be able to do stuff like margin calls and all that. But if they didn't, we own the collateral against the loan. So that's basically why a lot of people didn't lose money in this arena as well.
Yeah, and the worst Voyager loan, I believe, was completely uncollateralized. That was like the worst one that shocked everyone over the last month or two. Yeah. Do you guys remember if it was like 2 billion uncollateralized? I'm struggling to remember the exact amount. But
all these numbers were large and ridiculous. Like,
yeah,
because none of these companies have been around that long to take on this type of liability.
Yeah, so there was in some of those losses, we're now seeing like BlockFi and Nexo are still standing. Voyager and Celsius are in pretty poor straits right now and in bankruptcy filing. So there was some uncollateralized loans there. There was also what some crypto people would call like very degen type activity, freewheeling stuff. And there was a Celsius partner, I was just listening about this today. They had some partner that was doing well with a lot of their loan and DeFi portfolios, and Celsius was like, oh, we are hedging this. We are making protections against the risks you are taking. And in 2021, that provider found out Celsius was not really hedging any of that stuff. So that's been obviously hugely disappointing. I have some money stuck in Celsius. A lot of our customers are pretty in tune and got out early before that because they have more time to watch the crypto markets than I do. But what type of loans and how much protection you are putting is really important in that process.
And I'll put one more thing, the maturity of the loans versus the money that so the asset and liability is very, very important, because there were other trades that Celsius and BlockFi and did where, there was the grayscale trade where they tried to make money by, going long Bitcoin in the grayscale trust, trading at a discount and selling the Bitcoin on an overnight basis. And that's fine. If it's like with all levered arbitrage trades, if you can hold it to maturity, that's fine. But if you get a margin call, you better be able to, come up with that money. And if you can't, you're basically bankrupt. And so you need to be very careful. So for us, we would, we have monthly liquidity on, say, this USDC lending fund. All our loans are under a month maturity. In fact, most of them are 7 days or less. So we can never get stuck with having to pay somebody the money that we can't get from the lending activity. And that's just common sense, unless you have the Fed behind you, or which we don't. These are all private companies, and it forces us to be much better structured than the banking system, as long as we're not, willing to go down the Celsius path, which we are not.
That's an important point. No liquidity mismatch when you look at our USDC yield fund. I think we actually just talked through many of the points here on our risk management framework. Specifically, the auto liquidation, which again, it's not a discussion or negotiation, which has oftentimes led to some pretty poor outcomes. This is just rules based. We get our money back. But let's take a look at how all this input has come out the other end as far as performance. And here we're showing our USDC yield funds since inception of this past year back in June on through present. And we've done so against some other benchmarks that folks have utilized to kind of, in a similar vein, find yield and safety, floating rate loans and senior bank loans indices. And while we've vested both of those, we've also avoided this downturn that's taken place across all risk markets over the last few months. So as we've kind of weathered crypto winter here, if you will, in very kind of boring fashion with kind of steady monthly returns, that's really the goal of something like our USDC yield fund. More on the risk metrics of the portfolio. I guess the key point here is you're being rewarded for the risk you're taking on. You've got a high Sharpe, low volatility. Adil, I'm not sure if there's anything else you wanted to add here. Or...
Yeah, I mean, in the end, it really all comes down to the fact that the actual asset value never varies because of the USDC stablecoin, and the fact that if you're measuring it in dollars, it stays at $1. It doesn't move. And then the yield is got by this excess demand. There's a real structural reason for people to pay more interest on USDC living on crypto rails versus US dollars in the SWIFT accounts, in the SWIFT banks, which are inundated with liquidity and don't have anything to do with the money. Crypto people have a lot to do with the money, and they can pay interest on it. And we're just allowing normal people who aren't fully plugged into the crypto world to access this added yield that you can get. And so, yeah, the Sharpe ratio is going to be high because the asset value never changes pretty much. And if you look at any of these other products, you have to take duration risk. You have to take a lot of credit risk. Most of these other lending products have become uncollateralized. There's very little asset-backed lending in FRNs and things like that. I mean, you can get it in some mortgage-backed securities and all that, but those are different types of risk. So at the moment, it's really a unique opportunity in the crypto world. And as long as there's this mismatch of the banking system, I mean, you still cannot get banked as a crypto company by like Chase or JP Morgan. I mean, even last year, I was trying to start an SPV, and JP Morgan was all over us. We want to bank you. And as soon as they saw the operating agreement and had the word crypto in it, they said, well, sorry. We can't do it. So, I mean, they're sloshing around with money, but they won't give it to the people who can actually do useful things with them. So as long as that's the case, we'll be able to have high Sharpe ratios through the strategy. It's a pure supply-demand mismatch.
Yeah. So, just to quickly go through the key terms here. Again, this is a accredited investor-only opportunity. Minimum investment on this is $10,000. Monthly redemption with 7 days notice, K1 tax reporting. You see just a summation of our service providers there. And, a theme across all of our products is very low management fee. So at 50 basis points, we deliver this strategy. So, that's a very low volatility way to engage in crypto and something that's been very attractive given kind of the current market backdrop. But as folks look to think about, longer term kind of strategic positioning and more risk assets like Bitcoin exposure or even diversified crypto exposure, we have solutions there too that incorporate yields and other efficiencies like staking. So something like our BTC yield fund, the goal here isn't so much preservation, but more accumulation when it comes to yield.
Actually, the way I like to think about it is that if the USDC yield fund, right, is you put in dollars and you get back dollars, and you get back more dollars than you put in because you get a yield. Well, the BTC yield fund is you put in Bitcoin, and in the end, you'll get more Bitcoin out than you put in. Why? Because our fees are only 50 basis points, and we lend out the Bitcoin and make 3 or 4%. And we have an expense cap as well of 1%. So the most expense stuff going on in the BTC yield fund is 1.5%, and you're making 3 to 4% in yield. So, and it's redeemable, so you can take your Bitcoin out. So if you just think about the other ways of accessing Bitcoin and Bitcoin lending or yield or covered call or any type of these safe strategies, most people will charge you too much money. In fact, there's a competing product out there, which is, I guess they've crushed it over the years, but at the moment it's GBTC. And GBTC is a grayscale product. They charge 2.5% fees a year, right? And they don't do anything with the Bitcoin. It just stays there. But guess what? You can't even take it out. Once you give it in, it's like, Hotel California, you cannot check out. So you buy Bitcoin through the Grayscale Trust, and you're losing 2.5% Bitcoin a year. So whatever Bitcoin you put in, you'll get less Bitcoin out. Now the price might have gone up or down, but you'll get less Bitcoin out than you put it in, and you can't take it out. You have to actually sell the shares and take the money and buy Bitcoin. So that doesn't work. For us, you put Bitcoin in, you get more Bitcoin out. And yeah, you get the price appreciation or depreciation, all the risk. But the idea is that we're doing what we call beta plus products. And we have a Bitcoin product that gives you more Bitcoin back than you put in. We have an ETH beta plus product, which gives you more ETH back than you put in. And now we have an S&P index product. So our view is that, in cryptocurrencies, everyone should buy Bitcoin. Everyone should buy ETH and find the best way to do it. We have some very attractive ways to do it. But after Bitcoin and ETH, the plethora of coins, just like it explodes. There's tons. There's just like hundreds of coins. So we partner with S&P. S&P is a great index calculator, and S&P now provides indices on cryptocurrencies. So we chose one of the indices, which is called the S&P Large Cap Crypto X Mega. So what is that? It's all the largest capitalization liquid crypto tokens without Bitcoin and Ethereum. So basically, you can buy Bitcoin, buy Ethereum, and then lots of other stuff. And we say, be like a venture capitalist, because you don't know which one of these coins is going to be successful over the long term. There will be some 1,000x returns, but you have no idea which one. So, put a little bit in all of them. And if you had, small amount of money to actually go ahead and buy 50 coins, this index has approximately 50 coins in there. So here's a way where if you buy the S&P Securitize Capital S&P Large Cap X Mega Index Fund, your dollar will go and buy the 50 coins, and the coins themselves, over time, we're staking more and more of them. And staking for these currencies is a way to participate in the network and get network rewards. So like if you stake ADA, you stake Tezos, you get a yield on top of that, anywhere from 5 to 12% in helping to support the network. So again, if you want to, at the end of the day, whatever dollars you put in, you'll get the price appreciation or depreciation of this basket of 50 coins, plus you'll get the staking yield on top of it.
Adil, could we talk about how staking is different than what you're doing with like lending with USDC? Because we've talked about this a few times on webinars, but it's very often yield and stake get thrown together. Yep. And someone might misidentify what they're actually doing with their own money. So you could briefly describe like, what is lending yield and what is staking? You kind of just talked about staking.
Yeah, the lending yield is really, you have a coin or any kind of collateral or anything, you lend it out to somebody else and they give you more back. It's just a traditional loan that you get back, but it's actually a counterparty involved. There's another institution or another individual that you've lent it to, they use it for whatever and they pay you back. Staking is completely different. So staking actually takes the part of the proof of work algorithm for Bitcoin. So Bitcoin, for example, the way that the network assures the way that the network stays secure is that before a transaction is added to the block in the network, something has to happen. And the something that happens in Bitcoin is a proof of work algorithm that the miners do. So the miners make sure that the network becomes secure, because they cannot add transactions to the network until they do a lot of work, and they're economically incentivized to only put transactions in that are really, really good and correct. If they put wrong ones, they lose their effort. So that's a proof of work network, which is Bitcoin. Most of the cryptocurrencies out there are proof of stake networks. Proof of stake is this, the idea is that in order to add transactions to the network or write your transaction to the network, it's the validator nodes that are the proof of stake, the stake operators that take the transactions. And what is done is that you have to basically bet the amount of coins. Bet is the wrong word. You have to vote essentially with the amount of coins you have about what are the right transactions. And if you vote wrong for the wrong ones, you lose your stake. So there's an incentive to only vote for the right transactions in the right way. And that whole process is called staking your coins and supporting the network. Now, the trick is that, you shouldn't be able to figure out and co-opt a bunch of people with a lot of coins and change the outcome of a particular transaction. So what they do is they have a random selection. So if you have like 1,000 stake pools, only a few of them will be chosen each time. You don't know which ones. So in the end, it's like the random numbers help you in not being able to co-opt the entire system. So but because of that, people who run these stake pools have to be incentivized. They're incentivized by the network rewarding them with more coins. So instead of Bitcoin miners, they earn Bitcoin. Stake pools and stake pool operators earn more coin by doing the staking for individuals who have the coins. So really staking is about supporting the network and making it secure with whatever coins you're staking. It's a way to earn money without getting a job, actually. Yeah. Like this world, you can start a node and start earning money from the network, not by getting a job. So that's where staking yield comes from.
And thank you. And I think that really helps. And one important thing is, like, if there are no Bitcoin miners, Bitcoin would not be able to operate as a network. We hear Ethereum are moving to proof to stake. If there were no stakers in Ethereum, there already are, they're getting ready for it, the Ethereum network would stop working. So it's kind of like what, holds up this whole ecosystem. Is it a proof of work miner, or is it a proof of stake pool, as Abdul was mentioning?
Right. And think about it, all these are networks of computers, right? So somebody has to run these computers. So the incentive system has to be thought up of, like, why would somebody start a computer and start running this thing? Well, that's where staking, mining, all of these great innovations have come about to incentivize people to actually start the computer, run the programs, update them whenever they have to be updated, because they make a lot of money doing it. Right? It's pure economic incentive.
Yeah. And okay, let's get back to the S&P fund, and then we also have a question here. Is it all right if we have the question? Brian asked our question: does Securitize Capital engage in rehypothecation on the collateral it receives in the yield fund loans?
No.
Okay, very simple question. Sorry we had to wait for that very simple answer, but wanted to let them continue on.
No, because then it would become like it would become like leverage. Like, we're not leveraged in this fund. Yeah.
Okay. Right. And yeah, there are so many of these coins here. As we're talking about this other fund, like, a lot of times people call me on the phone and they say, "Oh, Brendan, you must know about all these cryptos." Frankly, I don't. I know about like 10 of them, or some hardcore customers educate me, like they're a Solana fan, or they're a Polkadot fan, or they're a Ethereum fan. And they educate me like, this is how this coin works, and this is why I think it's better. I use the Binance coin chain. And frankly, I don't even have time to keep up on all these. And I've been burned on a few trades, just messing around myself, of not timing them that well, or not really being aware that, hey, this coin is already like completely outclassed by 3 or 4 other new ones that are taking its thunder. So, I think an index like this is helpful to, an experienced investor and a new investor as well, is it just gives you wide exposure. And a lot of portfolios are already heavy in Bitcoin and ETH. So just know some indexes, they're like, wow, this index did so well, or I like using it, but it's like, it's 90% Bitcoin and Ethereum. it's not really giving you much diversity. It's like some people criticize our S&P now. It's like all Apple stock. It's all like 5 or 6 stocks. You're like, I already own those 5 companies. I don't really need more of them. I need the other 460 to be additive to my portfolio.
Yeah, and that was the idea. And I mean, your point about, these different coins, I mean, a property of networks, right? Every network, whether it's crypto or not, has various trade-offs between like how secure it is, how scalable it is, how decentralized it is. Like the US dollar network in the SWIFT, it's very secure, it's very scalable, but it's not decentralized at all. It's very centralized. So it can be shut off for anyone, right? They could shut it off for a whole country like Russia, and they could just, that's it. You can't use it anymore. So BTC is like, very secure and decentralized, but it's very, very slow. Solana, you mentioned Solana, is very secure and scalable, but it's very centralized. It could be shut down very, very, very easily, right? Ethereum is somewhere in between. And there's another 40 coins, and they're all good for certain use cases. And over time, those use cases will become apparent, and some of these will, grow to be really huge. We just don't know what they are. It's just like the early days in .com, right? Like zoo.com and all those stuffs are gone. I mean, when I first saw Facebook, I thought it was a joke. Why not, whatever that, there was other things that were exactly like it, but they became like very, very, very big. So you don't know what's going to work. And so
Litecoin was a very early leader. And frankly, I don't hear a lot of buzz about it at all. I haven't been up on recent news about it, but I just don't hear a lot of talk about it, frankly.
Yeah. So again,
Julie, I think here just the breadth of exposure is pretty much unmatched across other products in the space. So to your point, I think a lot of them are just 5 different coins at max. This is really full spectrum.
Yeah, and I like this product just for the same reasons that I buy my used to buy my own coins, and then you have to stake them, and you have to do all this. Now at an institutional level, you can do it and just buy one thing. And then if you really love something, go ahead and buy it separately, right? You could add to it always. But you buy Bitcoin, you buy Ethereum, and you buy the S&P X Mega, you pretty much have all possibilities that it's going to work in the next few years. Yeah, so that's it for this fund. I'll let Ryan go over some of the more terms of these funds, which are also very similar.
Yeah, I'll just point out really just 2 differences here on a minimum investment standpoint. These are $50,000 across our BTC, ETH, and S&P funds. And from a redemption standpoint, there's going to be quarterly with 15 days notice. Still 50 basis points management fee, same there. I wanted to just quickly point out again on the point of these being accredited investor opportunities. The accreditation process itself is something that we handle at Securitize via Securitize ID, and it's a very simple process. So this QR code on the screen will take you to our partnership page, and from there you can link directly to the Securitize ID page, or just go directly to our website. And it's going to do an identity check, a liveliness check, and essentially collect your basic information and how you're going to accreditate to get into one of these funds. So just an added step there I wanted to point out on the process itself. Also wanted to highlight that we have a website with a lot of content. We've been putting out on a consistent basis a weekly newsletter that takes into account not just the crypto markets, but kind of the macro environment, and kind of puts the 2 together. And we certainly take an opinion there as well. So I'd say it's a pretty good piece. QR code there will take you to our website if you want to add yourself to that subscription. And the other piece of housekeeping I wanted to mention, and Brendan had alluded to this in the front end, but for any new accounts that's coming into a subscription of a securitized capital fund from now through October 1st, we are picking up the fund or the new account setup fee. So if you'd like to take advantage of that opportunity and that promotion, please email me directly to my email address up there on the screen. Certainly send along any questions as well. Happy to add further commentary to anything we discussed here today. But let me stop there. And I'm not sure if there's any other questions that came through as we were talking, but
We just got one about lockups, and I know they were mentioned, but there's a couple lockup periods. So could you please just review again for the couple different funds, and let's talk about them separately. What is the lockup period and the notice period to pull funds out of the product?
Yeah, let me just start with the distinction with USDC yield. So this is really a vehicle for shorter term investment horizons. So when you look at this, this is going to be a monthly redemption with 7 days notice in that product. Now, as we look at BTC, Ethereum, and then our S&P product, these are volatile risk assets that we think people will be strategically allocating to for longer periods of time. With that, it's a quarterly redemption with 15 days notice. Okay.
Yeah, so to review, the USDC is much faster to pull out. The other ones you should be on a quarterly timeline. Feel free, if any questions now that you have, feel free to throw them at us right now. I just like it to get your opinion while we wait for some other questions, but what is your guys' opinion on DAI and Tether again, and why do you kind of, you mentioned a little bit earlier, why do you choose to really focus much more heavily on USDC than those other stable coins?
So our focus on the USDC yield fund is capital preservation first, no matter what. So it really is for people who have the least chance, or want to give them the least chance of losing their money. It's just like really bad things were to happen. And since we know for a fact what the actual collateral is against USDC, it's an easy decision. Tether, it is collateralized, and there are some reports that you can take a look at, but they have never been audited, and they refuse to be audited. And when asked about being audited, they never answer why they haven't been audited, but everything could be laid to rest by one audit ever. And then, at some point, it is known that when they did do even an attestation, there was like 400 million that was attested to in a bank account, but it only got there a day before and it left the day after. So those types of things, that's what an audit does. It actually looks at subsequent events and all that and makes sure that those types of games are not played. So since there's no assurance of that, USD Tether is one rung below USDC as far as trust goes. Now, DAI is great. I like DAI a lot, because what DAI is doing in an algorithmic way what we are doing, which is over collateralized lending, right? I mean, for every dollar, the DAI token that's out there, there's like, a whole pool of assets. I think 40% of it is now USDC, there's Ethereum, there's other coins in there, the liquid coins, but the market value of the collateral at any given time for the DAI token is like 150 to 190% over collateralized. And if that changes, they liquidate that collateral. So again, DAI is like the reason why it's inefficient is because it's totally over collateralized. So you have to put in almost $2 to get $1 out in a stable coin, versus USDC, you have to put in $1, you get $1 out. But that's because you have the assurance of the regulated US bank and US treasuries and all that. DAI, being an over collateralized one, you still have an assurance that and the algorithm is going to do its thing. Like there's no person who can say, sorry, you can't get your money out. You take your DAI, you give it in there, the algorithm will do its thing, you'll get your money out. So it's really a nice construct. It's one of the oldest stable coins done in this kind of pooled collateral, over collateralized way. And I think it'll survive for a very, very long time, because all the other experiments, they under collateralize. And once you get under collateralized, now you're taking credit risk. Once you get credit risk, you have people making decisions, and people make the decisions just like Celsius did, just freeze assets or do this, do that. So DAI is truly a decentralized protocol that's over collateralized. So I think it's great. There's not the assurance that people have that they have at USDC. I mean, at some point we could potentially do a DAI yield fund, but there, you really have to look into the actual protocols, the people using the protocols, and the secondary basis, and that is a different type of risk. I think it's a good risk to take, but we're not doing anything with DAI at the moment.
Yeah, and it just as Abdul, you talked about trade-offs. I think a lot of the DAI people really like the decentralized nature of it, where USDC is very good at working with big institutions. So anytime like I get on the phone with a crypto company, it's like 99% of the time, USDC is their only stable coin that they support. So they just have a lot of institutional adoption. And that's part of, working with the regulators in the US. They got to play that game. So there's some trade-offs. Sometimes hardcore crypto heads are like, I like DAI better than USDC because, they're not as tied to this organization or so on. But, those audited reserves, if you're owning a stable coin, the only reason you have it is for it not to go to zero or to provide some utility to somewhere else. So those trusts and reserves are important. And in the last couple of months, we saw a lot of tests on both the trusts and the reserves. So, when like a stable coin goes to 0.99 cents, that's when people's anxiety shoots through the roof. And that's where these measures of trust have to step in to calm everyone down and make sure things stabilize. That and feel free to add any commentary.
Well, this is it's also is another point to make about USD Tether, is that, and it's true for USDC, but it's not really relevant in some sense, because if you look at the mismatch of liabilities of USD Tether, even they're exposed, what they do report. Let's say we take it at face value and they have these corporate bonds and they have these, commercial loans and all of that stuff. If they were to have a run on the bank, they have the ability to just stop withdrawals, right? So yes, you can put your Tether and get it back, but like DAI, it happens with an algorithm, you will get it back no matter what. With Tether, if you demand and they don't want to give it to you, and they can stop it for any reason. If you look at the fine print of the Tether, issuance website and their issuance documents, they have the ability to do that. So when Tether started to go to like 95 cents, 92 cents, we seriously thought, oh, is that an arb opportunity? We can buy Tether and do the trade. But then what if they froze it? Then we're stuck, right? So suddenly, again, the same. It wasn't an asset liability mismatch until Tether decided, or if they decided not to give it back. And when would they decide? They'd decide when they were in trouble, when everything was going down. So it's like, it's a joint probability of destruction rather than something that helps you. It's like the opposite of diversification.
And what we've learned over the last couple of months is these terms of service and these kind of, the backing of the contracts and everything, like that's really when things are bent. Does the paper break or does the pen go right through it, or
exactly
hold back up, or the computer code, so to speak?
So I make one more point, if you don't mind, which is that, because there was this, there's Celsius versus, let's say, Luna, or the UST ecosystem. And the difference in my mind is that the Luna was decentralized. And yes, UST, it went to zero, but everybody basically, the thing is done. People have moved on, right? It's like, it's already people who risked their money, lost their money, and now they're doing different things. Whereas Celsius, centralized, you don't know. It's going to be in court case forever. It's going to take years. Lawyers will get most of it. To me, there's a two sides of the coin. You get decentralized, and you have something that actually works like capitalism should work. You do silly trades, people go off their skis, they lose their money, they move on. Versus centralized, you do stupid things, you lose your money, now you go to court and you wait for years, and it's like a nightmare.
So you talked earlier about like automatic collateral calling, like that's what a lot of people loved about the DeFi protocols, is like, my money is now, not all of it thankfully, but some it hurts, is stuck in Celsius. I might have to wait 6 months, 8 months, 2 years, maybe 5 or 6 before that's unlocked. A lot of the DeFi protocols basically unlocked automatically and unwound over the last few months. So we have a good question here from another attendee. What are your thoughts on regulation? Now that's like a vague question, but it's a really big theme right now, regulatory power.
Well, I'm a little biased in that, because the whole reason for Securitize to exist is to do things in crypto land that are regulatorily compliant. So the birth came from the ICO boom. When the ICO boom happened and companies were raising money through tokens, we actually, I was running Protege Partners, we thought, oh, we should issue a token for my fund and we could raise money all over the world. And compliance shut us down in about 2 seconds, right? Because that doesn't comply with any of the rules. And lo and behold, the Securities and Exchange Commission and all of these things have said that, ICOs are really, you can't do it. So we start to do STO, security token offerings, and security tokens use the cryptocurrency rails, right? But they do it with the SEC registrations, they do it with all the bells and whistles, so that you can get the benefit of instant transfer and global reach and all of that stuff. But it's not trying to cater to anything beyond what the regulators already have. And we work with regulators to have them approve more and more products. Now, the US is probably the most regulated market. It's also the biggest market because people trust it the most. Why do people trust it the most? Because it's regulated. So it's a two-sided coin. These are trade-offs. You can do unregulated things in other parts of the world. They'll be small because none of the large pools of capital will go there because they could lose it. So it's really, what do you want to do, right? And I think there's a place for the unregulated, like Bitcoin is unregulated and it's amazing. And I think I'm very pro Bitcoin, and it can't be regulated, which is fantastic. But the other stuff that is started by people, who are centrally involved and making profit from it, looks like a company, it's going to be regulated. I think it's inevitable. I think it's best to do the regulations in a way that doesn't kill the advantages of the technology. I think 3 years ago, 4 years ago, I thought it was a huge risk that regulation could shut down the entire thing. I'm cautiously optimistic now with what's gone on in Congress and the kinds of noises that are made, that it's actually somewhat seems like bipartisan and reasonable, some of the stuff they're considering. So I'm cautiously optimistic that regulations will again put the US at the forefront of this space, because it'll be good regulation that makes sense rather than just shutting it all down like what they're doing in Russia and China and whatnot.
Mm-hmm. Okay. All right. So there's another question from the same attendee. Are the securitized capital funds offerings regulated under any specific authority?
So all of them are Reg D products. So they're forms filed with the SEC. We are, at the moment, we're not already a registered investment advisor, but we will be. Mm-hmm. And for some of our multi-strat QP products, we are NFA regulated as a CPO. So we have regulations up our wazoo, basically. more regulations than I would like, but we have to do it. Because Securitize, when I said that Securitize did the security token offerings, we had to become a broker-dealer. So we have a BD license under FINRA. Then to allow the security tokens to trade on the alternative trading system, you have to be under NASDAQ and be an alternative trading system. And we have to be a transfer agent, because what does ownership of a security in the US mean? It means that the record keeping is kept by a regulated transfer agent. So in order for us to issue a security token on Ethereum or Algorand, we have to be a transfer agent. So security is a regulated transfer agent as well. So your token lives on a transfer agent that is just as good as Continental Trust that holds your GBTC shares, right? So yes, we are regulated.
Yeah, and I think what we're seeing in the news now, a lot of, there's almost a little infighting between the different US regulatory agencies of they frankly, they want a piece of the pie of they think it's almost exciting growth for their organization. I know. And, so you're seeing a little bit of that between the commodities and the SEC and, all these orgs are well, we want to regulate Bitcoin and Ethereum. And the other ones, well, we want Ethereum. You can't have Ethereum. So that's just been a challenge. The people at Securitize, obviously you've been through it before, but it's a challenge for a lot of crypto organizations. They're well, we need licenses. What licenses do we need? Well, we're not sure yet. These two apply to crypto, but we're not really sure if you're going to need a third one. So that is continuing to evolve. When you're talking to companies like Securitize, they've already had to go through and get a lot of these licenses. And Rocket Dollar, we work with trust companies. That's who we work with in the regulation is IRA trust companies. We have to kind of go out as we look to do new things. We have to go out and apply for certain licenses so that we can work with certain assets in different ways. All right, we're at 3:01 here. Any closing comments, Ryan, Abdul?
No, I would just invite folks that if they have any additional questions to message me directly, visit our website. Please engage with the newsletter. It's great content that we've been putting out. But most importantly, thank you, Brendan, for having us. We're very happy about the partnership, and please take advantage of the promo that we got out there through October. So
okay, Yeah, if you have a new, if you're looking to be a new Rocket Dollar customer and you're also interested in Securitize, feel free to email Ryan or myself. I can get you introduced for that offer to have no opening fee for the account. And then also next week, we're going to have a real estate webinar. So look forward to that. Thank you so much, Ryan and Abdul. I appreciate it.
Thanks a lot, Brendan.
Thanks, Brendan.
Everyone who was on.